Thank you for joining us for this evening's program. Tonight, we'll be discussing digital currencies and possibly what the future of money will look like with Robert Bench, Puneet, Singhvi, and Richard Bard. I'm Claire Noble, the Director of Programming for the Vail Symposium. On behalf of Chris Sable, our Executive Director, Dale Mosier, our Board Chairman, and the entire Vail Symposium Board, welcome. The Vail Symposium has been offering affordable, thought-provoking programming to the Vail community since 1971. Two items to be aware of before we get started. Please use the Q&A option at the bottom of your screen to submit questions for tonight's speakers. You can type those questions in there at any time. We'll get to those later in the program, and we'll get to as many as time permits. Tonight's program will run until 7:30. It's being recorded, and you'll be able to find that recording at vailsymposium.org. I'd like to take just a moment to thank the organizations and individuals who've helped make tonight's program possible. Our sponsors include the Town of Vail, Vail Resorts Epic Promise, the Antlers at Vail, and the Vail Daily. Our virtual programs are sponsored by Alpine Bank. Jeannie and Dale Mosier have underwritten the winter season, and tonight's program was underwritten by Dr. Alan Markowitz and Kathy Pollard, and Elaine and Stephen Schwartzreich. The Vail Symposium is also supported by a generous grant from the Frechette Family Foundation. Thank you to all of our donors at every level who make our programming possible. We couldn't do it without you. And a special thanks to Vail Symposium board member Lori Prentice, who was instrumental in creating tonight's program. Our next program takes place on Thursday evening, January 27th. We welcome William J. Peters, author of At Heaven's Door. He'll be joined in conversation with past Vail Symposium speaker, Dr. Jeffrey O'Driscoll. And on Wednesday, February 2nd, we host Thomas Wright, the director of the Center for the United States and Europe at the Brookings Institution and author of Aftershocks, Pandemic Politics and the End of the Old International Order. And you can find both William Peters and Thomas Wright's books at the Vail Public Library. Tonight's program focuses on the future of money. Richard Bard is our moderator this evening. He's the founder and chief executive officer of Bard Capital Group, a middle market private equity firm with a diversified portfolio. He's been involved in the acquisition and operation of several private and publicly traded businesses over the past 30 years. He previously served as chairman of the Federal Reserve Bank of Kansas City, and he serves as the key interviewer for the Vail Symposium's financial series, for which we are really grateful. Just a reminder for our audience tonight, please use the Q&A option at the bottom of your screen to direct questions to tonight's panel. We'll get to those questions later in the program. I'll turn the program over to Richard, and Richard, please invite me back when you're ready for audience questions.
Okay, thank you, Claire. Well, welcome everybody. This should be an exciting evening. I mean, we're talking about things that are new, different, exciting. Lots of change going on in the world around us. Most of us don't see it every day, but there is a lot of excitement around Bitcoin, around digital currency, around digital assets. And we have two wonderful resources that are going to join us tonight, one from the private sector and one from the public sector. And it's the timing is just incredible because the Federal Reserve has just published its first comments about cryptocurrency, and the valuation and volatility of that currency is actually what creates a bit of a mystique about it. So what was $65,000 a coin in November, today I think closed at about $37,000. So can this be a method of payment? Can it be a place to put your money? Can it be a good investment? We'll hear thoughts about that tonight from the panelists, from me, and from all of you. So Walmart and McDonald's have just announced plans to issue digital currency. The same with certain restaurants offering in their award system. Places like Miami, Florida, have issued Miami coins representing a stake in their municipality. And the mayors of Miami and New York City are the first mayors to take their salaries in digital coins. So what is this all about? It's quite exciting. Um, the level of investment so far in digital currency has been actually valued about $2.2 trillion at the end of 2021. That's probably down a bit today, given the swing in volatility. But we certainly have all heard about Bitcoin billionaires. And according to Forbes magazine, there are about 11 of them, the wealthiest being the founder of Colorado-based Coinbase, which is an exchange based here in Boulder. So we'll hear about digital currency, we'll hear about stablecoin, we'll hear about blockchain, which is the method for how this is traded, and hopefully give everyone an interesting background on what's going on in this very interesting new world that we live in. So I'll introduce Bob Bench, who is from the Federal Reserve Bank of Boston, and then he will present to us his thoughts, but also what's going on at the bank in terms of its participation in this on the research of blockchain and digital currency, and then I'll introduce Puneet Singhvi, who is with Citibank and Citigroup. So we'll get the private sector, we'll get commercial banking, we'll get lots of thoughts, and then we'll have a little panel discussion, and then we'll open it up to the floor. So let me first introduce Bob Bench. He's an assistant vice president in the Secure Payments Group for the Federal Reserve Bank of Boston. In this capacity, Bob's current focus is blockchain and what's called distributed ledger technology, which is what blockchain is all about, and private and government-sponsored digital currencies. The Boston Fed and MIT have been researching digital currency and assets, digital assets. His project is called Project Hamilton, which he can tell us why, which Bob will tell us about that, and the issues surrounding the trade-offs that the Fed is considering with regard to protecting users' privacy, but also preventing illegal activity using Bitcoin. So Bob, can you take over?
Yeah, you bet. And unfortunately, team, I have my video hasn't been permitted, so I'll speak like we used to do a couple years ago, and go into my presentation. What I'm talking today is about central bank digital currency research. This is an area of high interest at the moment. The Federal Reserve Board of Governors recently released a paper discussing the pros and cons of central bank digital currency and how that will be approached in the near future by the Federal Reserve. And importantly, this has been an area of technological research the Federal Reserve Bank of Boston has been working on for some time. Pardon me, let me start my video. All right, we are up and running, and I have a fancy background, which is really fun. This is great. I've never had this background before. So importantly, let's get to what we're going to talk about today and what we're not going to talk about today, because that's a very important thing for me to say as a Federal Reserve officer. Next slide, please. So first is central bank digital currency research. Why are we doing this? Why is this important to the Federal Reserve? Why is it important to my team in Boston? How Cbdc might be used. Cbdc is the acronym we have for central bank digital currency. How we are approaching central bank digital currency research at the Federal Reserve Bank of Boston, and then some of the common design and policy questions that have arisen, and how we plan on approaching that from the technological angle with our partners at MIT. Next slide, please. So important disclaimers here. Richard probably has heard these many a times working with the Federal Reserve. My views here are my own. They do not represent my bank, the Federal Reserve Bank of Boston, or the Federal Reserve System as a whole. My comments are only about technological research. So within the Federal Reserve System, the reserve banks perform system work, which is usually payments and economic research and technological research. So my team is exclusively focusing on technological research. And then importantly, the recent paper from the Federal Reserve Board of Governors came out last week. It was a fantastic piece of work, but that's the extent at which I can comment. The Federal Reserve Board of Governors will be the lone voice on commentary with that paper. So next slide, please. So the first thing when we think about central bank digital currency is, what is it and what makes it different from everything other forms of digital money? For most digital money, you're talking about financial institution funds. What does that mean? These are the funds held in your banks. The commercial banks hold most money in digital form. They're regulated by the states, by the federal government, and by the Federal Reserve or the bank holding company level. And most of the money that's moving between companies and people is what is effectively financial institution funds or digital commercial bank money. That money is all backed ultimately by accounts at the Federal Reserve in their master accounts at the Federal Reserve. But effectively, most of the money washing around the system is bank money that is backed by the Federal Reserve itself. There's a new type of money has emerged, or value, which is cryptocurrencies. And these sometimes are backed by real assets, but more often are backed by computational power, and importantly, the demand of a market to want it or not want it. As Richard introduced, Bitcoin has halved in the last several months from about $65,000 to the current levels around 30. And when I first started looking into Bitcoin, it was, I think, 28 cents. So it's gone really high and it's gone down. But that's the nature of a lot of assets. Many public shares of companies have gone similar levels. But the important thing here is that there's a new type of way that value moves over the open internet and outside the rails created by the financial institutions. A new type of digital money that's built on the cryptocurrency rails or blockchain is what's called stablecoins. And stablecoins are cryptocurrencies that are backed usually by real assets, often commercial bank deposits or government securities, sometimes by mathematical computations like algorithms that attempt to keep them stable using other types of digital assets. Stablecoins were very small in value up to several years ago. And in the past several years, they've gone into the hundreds of billions of dollars. And the current market value of stablecoins is about 130 billion, largely held between two companies. Tether, which is a company that has had multiple jurisdictions, but keeps most of its value in the Bahamas. That has about $80 billion backed by unaudited funds, primarily claimed to be commercial paper. And then by the US company Circle, which issues US dollar coin and has approximately $40 billion in value that is backed by commercial bank deposits in the United States, as well as Treasury securities, and is audited by the firm Grant Thornton. So we went from commercial bank money that we know well to cryptocurrencies that are largely backed, depending on how you look at it, either by the demand for them or nothing. And then stable coins are taking that ability to move forms of value on new types of rails to commercial dollars in some sense that are represented on these same tokens. And now we're talking hundreds of billions of dollars in this new type of rail in dollars. So that gets interesting. And then the final bucket is emerging, which is central bank digital currency. And what central bank digital currency is largely seen to be is central bank money, no different than a dollar in your pocket. But as opposed to that dollar in your pocket that is a physical representation of a central bank liability, it's a digital representation of a central bank liability. Now, depending on the country and depending on the policymaker, these funds can go through financial institutions and be held exclusively within financial institutions, which many countries are doing. Others are offering these funds directly to citizens, so a digital form of cash. These can be seen as a useful tool for the wholesale sector, or that being primarily commercial banks and large private entities. Or some people see them as a great solution for regular day folks to pay small dollar amounts, to pay their taxes, to get public benefits. There's a lot of potential directions this can go, and where we get to there is why we think this is really important research. Because no matter in which direction policy makers want to point this potential tool, the tool needs to be built on incredibly solid technological foundations by people who have done this well for a long time and have done this live in production environments. So let's get into why the Federal Reserve is doing this. Next slide, please. So why did we think this might be important research? Well, one is, as I noted earlier, money is moving outside these traditional payment rails. For a very long time, generally since the early 1970s, large commercial banks, along with large central banks, have directed the flows of money on the digital level. Bitcoin changed that equation by moving value over the open internet. If you had an open internet platform, you could move value. Now, Bitcoin would go up and go down, but you wouldn't need a bank. You wouldn't necessarily need to know your customer rules. This changed the game in some way. As I noted, values are up. And then bigger players got in the game. JP Morgan Chase launched JPM Coin, largely currently an interbalance sheet mechanism, but a great internal experiment. And importantly, Facebook prepared to launch DM and has now slightly changed that equation. But importantly, if the technology was there and we're a network such as Facebook that has several billion users, choose to place a form of value deeply embedded in this platform, that becomes very interesting from a financial payments rails standpoint. And that makes central bankers think, how can we learn how this technology works so we get smarter on it? Nations began building them. So Venezuela early on created something called the Petro, which was attempted to take oil revenues and place in their cryptocurrency in order to effectively circumvent US sanctions. It was largely deemed as unsuccessful. China very early on realized potential and began researching this in 2014. This has emerged now as what's known as ECNY, which has been launched in the Apple Store in China and is ready to do its full-fledged debut in full production scale at the launch of the Olympics. Importantly, China has been effectively the leader in digital mobile phone-based payments for some time. Alipay and WeChat volumes greatly exceed that of MasterCard and Visa, and certainly greatly exceed that of American or Western mobile payment apps. So they have people who've been doing this. Consumers are ready for it, and they're launching. So that's interesting. So you have an economy the size of China that's going live with a digital currency. And Sweden has been researching because Swedes don't like cash. And so what do you do if people want cash but don't want the paper side of it? So Sweden's understanding what that looks like. And so again, we're the global reserve currency. We need to know more about this technology from our perspective. And so we are working on the technological side. On the side, and another important area is that Congress started putting this requirement into a couple bills. When we were discussing as a country, how do we respond to the pandemic, early drafts of the CARES Act included plans for universal Fed accounts. These weren't final, but the Federal Reserve is subject to congressional oversight. And so if Congress starts discussing new tools they may want us to implement, well, we better get tool makers working on understanding how those work, so we're prepared in case they ask us to build something. And importantly, since that time, since these things like universal Fed accounts and central bank digital currencies became discussed as a potential tools to solve problems, Congress has kept asking about publicly. And so again, we want to make sure that as the provider of safe, efficient payment rails for the country, that we understand all the options for payment rails from a technology perspective. Next slide, please. So what are the uses? So again, importantly, our research is just on retail central bank digital currencies. The Federal Reserve Bank of Boston, in our technology side, find the retail question the most interesting. Certainly, we think there's significant research to be done from a technology standpoint on wholesale. And we foresee folks within the Federal Reserve working on that who are experts in wholesale banking. We find the retail CBDC question very interesting. So one case is person to person. So sending money person to person can be expensive depending on where you're sending it. Fees can add up for small dollar amounts. Is there a use case for Americans to send money to other Americans effectively for free? And what would it take to do that? And importantly, as this is the Vail Symposium, I'm sure there's lots of places in the Rocky Mountains and in our larger plains areas that don't have perfect internet coverage. So if you're buying a pie from a local pie stand and there's no local internet, and you want to use our digital currency, does that pie stand go out of business because there's no internet there? How do you make it so that buying a pie or buying a couple head of cattle doesn't require the internet? So what does offline capability need from a technology standpoint? Do we need to look at radio signals? Do we need to look at Wi-Fi or Bluetooth? These are all important considerations. Very importantly, cross-border peer-to-peer payments is very slow and very expensive, often for those who can pay the least. So were those economies globally that have significant remittance fees and significant remittance economies, how do we make that less expensive so that transition cost doesn't hit these economies so much? So that's something that we think about. And from a technology perspective, how can we make that happen? Or understand the cost or the benefits. Consumer to business is important. Richard just talked about Walmart looking at a digital currency. So Walmart pays a lot of money to the credit card companies. Maybe they want to pay less. Maybe they want to pass on that fee to their consumers less. That may be an important issue for them. Similar with McDonald's. So what would it take from a technology perspective for these firms to service clients at the volume of a Walmart? What do they need to know? How many transactions per second do you need to handle Walmart's American customers? So these are some things we think about. Real-time payments is something that is emerging in certain technological circumstances where Amazon has opened a store in Seattle where you walk in the store, you take what you want, and you leave. And scanners in the store know what you bought, and it automatically feeds it to your phone. Amazon thinks that might be the future of retail shopping, with no tellers, just scanners and sensors. So if everyone's doing things that way, how much throughput is needed, and what do you need to evaluate to understand how Amazon might run all their stores that way? And again, cross-border remains a challenge, consumer to business. And then business to consumer. If you're driving an Uber, do you want to be paid per trip or per mile? If you run a labor business, do you want to be paid by the minute, by the hour? Do you not want to be paid every 2 weeks? What type of possibilities are there with that type of real-time payment system, particularly for gig workers? And how can we enable that technology and understand the costs and benefits there? And then what the roll up all there is some of the Fed is increasingly focused on is just financial inclusion. Are there frictions in the payment system from a technological basis that can be removed using technology? And can that bring more people into the economy? And that's something that is a wrapper effectively around all of our work is how do we make this more efficient and bring more people in? Next slide, please. So what are we doing? How are we trying to solve this problem? So what we have is what we named Project Hamilton. This is named after Margaret Hamilton, who built the bulk of the software for the Apollo mission at MIT. Famously has a stack of paper larger than her height, which was the software code that enabled the lunar lander to work. And then obviously, of course, Alexander Hamilton, the first Treasury Secretary and founder of the predecessor to our Federal Reserve. So we're trying to understand what technology is required for this software to work. We partner with MIT. MIT's Digital Currency Initiative is the longest running research institution in the world on digital currency. They've been doing this since 2015. And some of the founders and original scientists of the world's most stable, long-running cryptocurrencies work in this shop. And that's important, is that while this is research, you want to have people that have done things real and have kept things in production for real over long periods of time under significant stress. And that's what we did. And then the leadership of the Boston Fed and I hired senior engineers from Circle, which launched USDC, and some other firms who had also built production environment, high quality digital forms of money to say what's real and what's not. Where are the costs and benefits, and how can we push the horizon to better understand how this might work or not work, and then better inform policymakers. So what we are doing is we're building from scratch a hypothetical retail central bank digital currency platform. Now that's a lot. What we've done this year is built a transaction processing engine, which is we want to see how money moves very quickly, very stably, with instant settlement, and how can that be used to better understand design features that policymakers might want, and then test them. We'll be publishing these findings shortly. Importantly, the Federal Reserve Board of Governors released their paper last week, and we hope to follow up in the near future with our research. And then importantly, our project is technologically agnostic. So while a lot of this discussion is about blockchain, we're not just trying to stick a blockchain on top of the dollar. What we're trying to do is understand, well, what are the costs and benefits of trying to put a blockchain or the dollar on a blockchain? Or there's a lot of other systems out there that might do the trick. What are the costs and benefits of each? And how do we weigh those? Next slide, please. So what does our research project look like? So first off, as I noted, we built a core engine. And this core engine is understanding how many transactions a second can we go. We were trying to go as fast as possible because we think the future will require that. How quickly can we clear and settle? How resilient can it be, right? So one thing we think about is if this is American digital dollar, you may have hurricanes on the East Coast, you may have earthquakes on the West Coast. So how do we make sure that this is available for all of America all the time? An earthquake and a hurricane happening concurrently can't shut this down. And then importantly is security and privacy. This needs to be a highly secure, highly private piece of software if people are ever going to use it. So that's our core platform, and we hope to release it soon. Then phase two is taking those core metrics, such as transactions per second, and then taking common design requests, such as privacy versus AML, anti-money laundering compliance, or programmability, and then understanding what's the cost of adding, say, programmability to the transactional speed. Does it slow it down? Does it make our software less secure? And what are the trade-offs there? So that if policymakers ever get asked to build this, or Congress wants to have a data-rich conversation about this technology, we can show them the results and at least have a starting point for that conversation. Next slide. And while we're doing that with MIT on our build from scratch research, one thing we understand, as most of the team came directly from the private sector, is that you have brilliant women and men working on this already. You know, one of America's greatest strengths is its private sector and the innovation that has kept driving our country forward has come from the private sector. So what we're doing is taking our testing engine we've built. Think of it as a driving rig where you can, test the horsepower of a car. We're going to reach out to the private sector and understand, what have you built? How can we learn from what these folks have built that may help us understand this technology better, help us ask new questions? And the purpose there isn't to, say, pick a winner, because we haven't even decided whether we're going to do this at all, but to understand better and to bring in the brilliance of the private sector into the conversation. Next slide. So as we move forward with our technical research and as we begin to work with the private sector and understanding what we're circling around some common design questions from a technological standpoint. So first is privacy. Our financial system has a bit of a cover charge situation where if you want to do business in this country, the financial system needs to know who you are. But at the same time, we have cash, which has an implicit assumption of privacy. So how do we research and understand how a digital dollar might work, while also ensuring Americans can feel comfort that they're not under a constant surveillance system? And what are the trade-offs there from a technology standpoint? So that's an important research angle that we hope to accomplish. One question is financial structure and distribution. This is more of a policy question, but are there technological differences from us building a CBDC that goes only through the banks or one that could go to Americans directly? We think there's, the Federal Reserve thinks there's considerable policy questions about that, but from our standpoint, it's, does the technical design differ? Importantly, security is something that we will be testing constantly. While we are building this platform with some of the best cryptographers in the world, we know quantum computing is right around the corner. And quantum computing can enable persons with the right computers to break almost any encryption on the market today. So how do we future-proof our project, a little bit like the year 2000 bug, so that if quantum computing occurs, that we won't be threatened? And then constantly is a question of innovation. How do we make sure that this technology doesn't signal to private sector actors or new researchers that we're trying to crowd you out, right? One thing we're focused on is innovation is a major tool of government and a major tool of the private sector and academia. So to that end, one thing we're focusing on is our platform will be entirely open sourced. So anyone who wants to work on our software can, much like the Linux platform that now runs most of the world's servers, and anyone can work on it anywhere in the world. We're hoping that this open source software will enable private sector, academia, and the government to think of new ways to make money move faster, more securely, as a research platform to better understand how it might be used in the future. Thank you all for the time. Richard, thank you very much for the very kind introduction, and I look forward to answering questions.
Let me now introduce Puneet Singhvi. So Puneet is a managing director of Citibank. I think they now call themselves Citi. When I worked there several years ago, it used to be Citibank, and before that, First National Citibank. But he's in the modern era. He is the current head of the blockchain and digital asset research for the bank, but importantly focused on the bank's institutional client group and looking at their needs and with regard to digital assets and digital currency. And Citi, before prior to offering any products and services, is studying the evolution of this regulatory landscape and the associated risks that Bob was talking about to meet their own regulatory framework as a bank and the supervisory expectations they would have in being involved in digital currency. So Puneet, can you take over?
Thank you, Richard. And thank you, Bob. That was fantastic. I think you laid the foundation. I really commend the deep policy thinking, the deep technological assessments which are underway because of the systemic nature of this activity. And when you issue a Cbdc, this is definitely very systemic and requires that tremendous amount of deliberation before. So we are very actively watching, participating. Just to kind of remind, from a Citi perspective, I represent the institutional client group. We are financial partner to governments, corporations, financial institutions globally. Citi is a very global institution with physical presence in over 95 countries, serving our clients domestically and their cross-border needs with a very large payments franchise. So from our perspective, evolution of this space is extremely important to keep abreast of. And there's a lot of work going on. On the other side, we get the benefit of seeing how internationally, whether it's governments or domestic sectors and private sectors in various nations are looking at it, be it Eurozone, be it in Japan, be it in Asia, be it in UK, Africa, Latin America, and so on, which is again, very fascinating. We do see that whole spread of digitization of currency and new formats of currency coming into play. So from central bank money and tokenized form of central bank money, be it for wholesale use, where it enables a lot of wholesale activity, be it on cross-border payment side or on security settlement side, and as well as the retail side, which you covered in depth. in which Bob covered in depth in the prior session. We see commercial money and how commercial banks are trying to engage in this space through tokenization mechanisms. We see e-money, which is effectively non-bank payment companies, kind of stored value kind of scenarios, which are engaging in this space, the public cryptocurrencies, and then the stable coins. Overall, based on our last assessment, over 80 central banks globally are now exploring blockchain technology and thinking about central bank digital currencies and what it means. So some of the smaller ones are going to go live probably this year. Some of the larger ones are going to do much deeper assessment. We are seeing multitude of banks which are working on tokenized commercial bank money to facilitate internal processes, but also better services for the corporate and retail customers. And then lastly, this new emerging sector called stable coins, which effectively takes the money, deposits into certain short-term instruments, but effectively collateralizes that and issues a token on a blockchain network, which has grown to over 150 or maybe $160 billion and has been a new era of innovation. So when you see this whole gamut and you see it globally, one thing which we always worry about is that this enthusiasm will lead to fragmentation, will lead to systemic risk, lead to undercut the benefit blockchain offers. And one of the things which we've been working through over the last several months is working with institutions, with other institutions, other banks, central banks, et cetera, to think about how to promote interoperability, how to promote harmonization. And a lot of work going on through certain innovation hubs, which Bank for International Settlements has. But some work we did late last year and are proposing more actively now, which was done through a hackathon, which Monetary Authority of Singapore organized. Citi, along with Goldman Sachs, Bank of America, Wells Fargo, PayPal, some of the technology companies, local domestic banks in Singapore, we proposed a DLT network where the central bank money, the commercial bank money, the e-money, stable coins could actually reside on similar network. They become fungible with each other. One concern I always have is that if we see multitude of commercial bank coins, we see multitude of stable coins, we actually don't have one single currency. That's not US dollar. It's US dollar in multiple forms. Could that dollar in multiple forms actually have bases between them because there's different prices? Potentially. There could be minor bases, but there could potentially be bases. What does it really mean in long term? How should we really think about it? So what we're calling this proposal is called Regulated Liability Network. We're working with other institutions and thinking through how to technologically test those. Plethora of technology companies are engaged in that space, trying to prove of the concept. There's, again, very early days in that, but our thesis is that whether it's through standards or common technological rails or consistency in approach will be very critical for this, the future of money to actually be fungible, future of money to actually drive efficiencies which the technology promises. So that's been an extensive amount of effort and work from our perspective, which has been underway, and are happy to talk more about it if further people have questions around it. There was another point which was very interesting, and I think earlier when we were talking about folks who are joining today, to just briefly talk about blockchain and take a couple of minutes explain what that really is and why all of this, this whole new innovation streams which are generated out of that. But if I were to just keep it simple, typically institutions and corporations and individuals all have our own ledger. That's our ledger. We could have a replicate of that somewhere else in the bank or elsewhere else if you have loans from somewhere else and so on. What blockchain essentially does is creating, again, I'm simplifying in many cases, is a single ledger, a single source of truth, where multiple parties, based on the rights available to them, actually have view into that single ledger. What also does, through the technological underpinning, which is underpinned by cryptography, which is underpinned by the structure of the database underlying it, is a trust guarantee. And the trust guarantee effectively says that the rules of the system cannot be changed without a due process defined in the governance protocols. So unless you do that, the rules are known, they will not change. And it's a guarantee which the system is giving to participants who are engaged in this. And the other component, which is very interesting, is a concept of smart contracts. Simplistically speaking, once you have common ledger, you can actually have shared process, which is if-then rules, which are working on that common database, automating a significant amount of processes. So when you think about, oh, can money be smart, where I can say only if the house deed is signed and that evidence comes in that the money get released, and those simple interactions, whether it's in the individual domain or corporation domain, could actually get automated. So when you mix all of these together and then add this unique promise around auditability, that any transaction which is in blockchain is auditable, it's immutable because the way cryptographically designed, you can actually change it once it is booked on the blockchain. If there's any error, you can reverse it and rebook it, but you really can't go and erase an old transaction. And provenance, where you can actually see the history of transactions. So plethora of these unique characteristics which blockchain networks provide is what is really driving a lot of those discussions. And I absolutely agree with Bob. When you think of a CBDC, does it have to be based on blockchain? Not necessarily. Maybe it is based on a different kind of database structure and just uses some components of blockchain, which could be smart contracts working on top of it. So effectively, when I think of blockchain, I think of these as Lego blocks, where you have all of these options available. You don't have to use all, but you have opportunity to use based on what you're going to use it for. So just want to highlight kind of those two areas. One is just basics around blockchain, happy to talk more about it. And two, how we think it's important as globally money gets, kind of new forms of money gets created, that we start thinking of standards, harmonization, and integration. Otherwise, we'll have a very fragmented infrastructure in the future. So Richard, I know we have a short time, so I want to open it up for you to kind of get into Q&A or the panel discussion.
Thank you, Puneet. That was very interesting. And thank you, Bob, for your presentation. I think there's probably a lot of people with a lot of questions, and I think we'll have a little discussion first, and then we'll turn it over to the audience. So lots going on. I think in large part, somewhat confusing. You know, I think there's so many different cryptocurrencies. How does this work as a payment system? How does this work as a uniform investment? And what role can the federal government or the Fed play in either regulating this, making it safer, making it less volatile, making it either a sensible investment or not? So I kind of wonder about, I'm sure the audience wonders about a lot of those things. So we'll get some, I'm sure we'll get some questions on that. Puneet, thanks for talking about blockchain. I'm still confused. So we'll see how that goes. So I have a question for Bob. In the last, I don't know, 5 business days, you know, Bitcoin has gone from, as we talked about, once was $65,000 at the end of November, down to a low of about 33,000 over the weekend. Coincident with the Federal Reserve putting out its first paper about its for comment about its interest in creating a central bank-based digital currency. Do you think the down slope or the down valuation of Bitcoin and the other cryptos is related to the Fed being a potential competitor for, you know, in the crypto market?
So I think, you know, one, you know, I can't speak to any kind of investment thesis on Bitcoin or even interest rates. As you know, Richard, we have a more brilliant economists at the Federal Reserve than maybe any institution in the world, and I am not one of them. So I will not get myself in trouble there. I think from a technological standpoint, Bitcoin is not used as a payment system as a general rule. Its transactional fees are extremely high based on the computational model in the current technology of Bitcoin. I have been in that industry for a long time, and if I knew how to judge the prices of Bitcoin, I'd be a very wealthy man, Richard. But I think importantly what the Federal Reserve Board did, which I can't speak to very much on the paper, is they outlined some of the pros and cons of central bank digital currencies, which I think have a very different use case than Bitcoin, which to this date is effectively a digital gold, an attempt at a store of value from a technological basis.
Yeah, but it doesn't really store value. It's basically, as you said, I think, based on supply and demand, and the demand for, there's no underlying assets. So it's an interesting, it's really a speculative investment, is it not, Puneet?
That's absolutely right. Kind of from it's a demand and supply based, entirely demand and supply based, and people think of it as store of value from an inflation hedge perspective, given that there is a constant, the code decides the new Bitcoins which can be generated after a particular amount, there won't be any more. So this creates this level of digital scarcity, and then kind of that drives some of those thinking. When I think of money on the other side, and kind of, if you go one-on-one, what is money and what is currency? Is like a unit of account, a medium of exchange and store of value. And we remember that all the time. And then whenever we think of that, kind of you contrast and say, how does it fit those characteristics? So I think that is going to be the debate discussion. I do feel we're in the early stages of a lot of this work. The innovation cycle is kicking off, and we would expect more to happen. Also, when you think of broader blockchain networks, I mean, Bitcoin is one component, but now we see these new blockchain networks which are built to drive use cases, built to drive opportunities to build businesses on top of it, or applications on top of it. So we will also see this innovation cycle over the coming years also focusing on what could be new applications which could reside on these blockchain networks, be it Ethereum or several others which are trying to find the right kind of cost benefit, scalability, privacy equations. But those applications is what also is an interesting area to look through, because that could drive new sort of capabilities which we did not have.
So, Puneet, when I still see headlines of big numbers, like I think $1.4 billion of fraud in the cryptocurrency world last year. How does that happen with blockchain as its core technology and security blanket?
Yeah, Richard, where I see most of that happening is at the endpoints. So in order to access that network, you need to access through certain mechanisms. And if those mechanisms to access are not secure, could lead to cybersecurity issues associated with it. So if you're accessing a Bitcoin blockchain through an intermediary who's providing you access to that, and typically that happens through store of private key, which is kind of in your wallet, and that needs to be entirely secure. And if that is not very secure, and if anybody get access to that, they effectively have control over whatever you own. So some of those cases around fraud are also driven by the endpoints where the access to the blockchain network happens. Again, in certain cases, we've seen certain blockchains which might have certain issues, operational or otherwise, but most of those scenarios have happened typically at the access points.
So it could be the phony exchange or something like that, where a consumer gets money in an unsecured situation.
That's right.
Really interesting. So, Bob, I know you can't really comment on certainly Fed policy, but I mean, if you had a crystal ball, do you think that someday we'll all have digital currency and not be handling dollars anymore, paper currency?
I can't predict whether we will. That's, I think the chair has made clear, is involved a lot of stakeholders, including Congress.
Yeah.
What I do think we'll be able to do is, I think the research we'll understand how it works. We'll understand how to do it. And I think we'll understand through larger engagement with the technology community of what are these pros and cons. And for example, Richard, you brought up the question of fraud. That's an enormous question, not only for the cryptocurrency space or the digital currency space, if you will, but for banks. It's a monster issue for the banking sector, especially when you have humans as the endpoints. So were we to be asked to make a digital dollar by Congress, we'd have to make sure that's as secure as possible for every American. And of all levels of technological capability. And so, well, I can't give you an answer on whether it's going to happen or not. I know we have a lot of work to do because, as you noted, Richard, there's a lot of fraud out there. We know there's a lot of fraud with the traditional banking sector. And so we better get it right. We better know a lot. And it takes a lot of smart women and men working very hard on these questions to get it anywhere close to a point where we could confidently say we're ready.
So I mean, both of you are researchers, which is awesome. How do you think about, I'll open this to both of you. Is this a disruptor or is it disintermediate the banks? What's the role of digital currency?
As a member of the banks, Puneet, I'll let you go.
I mean, periodically, technological innovations cause disruptions and they cause change in the nature of services which you provide. So as this happens, there's likely change in the nature of services you provide. And for institutions who are thinking about that, are actually planning for that, can cater and modify their services for that. So this is how I typically think about it, that as money changes form, and if that were to happen, the provision of services and the way mechanism of provision of services might change. Maybe the kind of services we provide will change. So we have to be cognizant of that.
Yeah. Well, Bob, I know, Jamie Dimon has been a vocal, what do you call it, enemy perhaps of cryptocurrency, or talks it down, thinks it's too risky. I presume that at some point the commercial banks and their role will be part of your research, right?
Well, I think importantly, we want to understand at some point along the level of whether there's technological differences between running these, what's required to run these through the large commercial banking sector. Importantly, the Federal Reserve is underway with its most revolutionary technological production work in 40 years, which is FedNow. And so, focused at the Federal Reserve Bank of Boston, we have hundreds of women and men who are engineers, payments experts, lawyers, regulatory experts who are understanding how do we build a whole new payments rail, including the large banks like JP Morgan Chase and the smaller banks. I don't know if there's a First National Bank of Vail, but I know there's a First National Bank in almost every town in New England. And one thing FedNow has been about is making sure that the First National Bank of Kinderhook, New York, has just as good technology or close to it than its large bank competitors. And so, importantly, we're learning these rails. We're learning them well. And I think also importantly is, the Federal Reserve has been making payments better and more efficient for 50 years, at least since the 1970s when we started the new Fedwire networks. And so this is, I think for experienced folks who've been around the block a couple of times, this isn't all that new. Our goal is to make payments more efficient, more safe, less costly. And I think that's the goal of our private sector partners as well, the commercial banking sector. Puneet and his team are probably always asking, how can we make our customers happier? How can we make this less costly and do our more value-added services to them? And so I think, we continue to work in close coordination with the banking sector to make sure that all Americans have low-cost, efficient, safe payment systems. And I think it's going to take both sides to get the job done.
So Bob, can you talk to Zelle, which was the digital currency that's sponsored by most of the big national banks?
Yeah, so our team is not working with Zelle. I have not worked with them directly. We are not at that phase of our research. But certainly we look to Zelle to understand how they built what they built. It's when I was in the private sector, that's something we obviously looked at because it's a heck of a piece of work by our large commercial banking firms. And then we look to how can we even do better than that. But the Zelle is not currently in our scope of research. But again, that's another great example of commercial banks working together to make payments more quick, less costly, and safer.
Yeah, I think for everyone's benefit, it was put together by JP Morgan Chase, Wells Fargo, and several other banks to sort of create their own peer-to-peer currency or coin effectively to do peer-to-peer transactions, no different than Venmo or PayPal or Google Wallet or Apple Pay or I think it's all in the same genre, isn't it? I'll pass that to Bob.
So I do not know the exact rails that each one of those move on. Again, the important thing about Zelle or PayPal or Apple Pay is, for the most part, it's still commercial bank money, right? That's still money that's digitally held in commercial banks, and that money is moved via messaging systems between the banks, and that's settled. I don't know the settlement size there. I think the difference with central bank digital currencies, how they're normally defined, is that they're liabilities of the government directly, or the central bank directly. And there are some differences there in that they could be structured in a way that the government has a larger account balance, or banks have an account balance. But remember, Zelle, PayPal, Apple Pay, Venmo, that's all commercial bank liabilities. And I think that's the main differentiator between them and central bank digital currencies.
Yeah, well, it's a bit like a stable coin, right?
That's a great point. A lot of people argue that.
Yeah. So Puneet, it's so interesting that Tesla came out, or Elon Musk said that, you can buy a car with Bitcoin. You have lots of different and growing acceptance of cryptocurrency as a payment method. And so you deal with institutional clients and money around the world. It seems like almost ironic, I guess, that cryptos have been following this market swing toward away from risk assets, and it's so widespread that it actually becomes part of the norm. Do you feel that way?
I think over the last year, 2 years, the number of folks actually holding this and the wallet, access to wallet, definitely has grown exponentially. There have been limited set of situations where corporations accept it as a means of payment. And in many cases, the volatility which is associated with it has a thinking there, but also longer term from the Federal Reserve perspective, or central banks anywhere, is the impact on monetary policy and thinking about what does it mean from a monetary policy perspective and fiscal monetary stability perspective. So there are multiple dimensions of this. There are dimensions around legal and contractual structure. When you paid, is your debt paid? Who legally states that debt is paid because you're paying through that mechanism? So as I said, I think we are in a start of an era where there'll be a lot of innovation. We'll probably fail in many. Some things will be very successful, which will have significant impact. But we have a lot of building blocks to put in place as we go through these cycles.
Yeah, I would agree. So I think, hey, Claire, can we move to the audience questions?
Yes, thank you very much. So Puneet, since you used the term fungible, I'm going to direct the first question regarding fungibles to you. And I'm going to ask you, for those of us who don't live in this environment, to first define the term fungible versus non-fungible, and then address Clint's question, where he asks, what do you think of non-fungible tokens as a hedge against bear markets with fungibles?
Yeah, happy to talk through the difference. I don't think I could comment on the hedge component, or also cannot offer investment advice. So just when you think of fungible, the US dollar which you have in bank account A versus bank account 2 is fungible. US dollar which you have in your pocket is fungible. What you have bank, you go to the bank, you can deposit it, you can withdraw it. It's entirely fungible. It becomes non-fungible when each piece is unique. So if there's a piece of art, it is unique. It's non-fungible because that piece of art is unique and it is what it is. You really can't say, hey, these are so when there's this whole new innovative cycle around non-fungible tokens, they are looking at these pieces. It could be digital piece of art. Some cases it could actually correspond to something physical. But that token representing the ownership of that underlying art piece or physical object. And it's non-fungible because it's unique. It's associated with that particular object. So that's really a difference. Fungible, where it's like currency, which is very fungible. Non-fungible, which is unique and connected to a piece of an object.
Thank you. My next question comes from Jim, and we'll start with Robert Bench with this question. He explains, my son-in-law invests in Bitcoin and says that to convert it to regular currency, one has to advance 20% of the amount you want to convert to the exchanger in order to do so. How does this work, and who gets to keep that 20%?
I can't speak for the specific fiat to Bitcoin exchange that this person's using. And I certainly can't give investment advice. The Bitcoin to fiat market is becoming more and more efficient. So I have not heard of that specific exchange that has a 20% rate. That's very high from my personal experience after working in the industry. Yeah, I can't speak any more to that.
Can we stay with you for our next question?
Sure.
This comes from Richard Kastenbaum, Triangle Capital. He writes, the Fed works closely with banks to implement monetary policy. How does the Fed balance that relationship with the fact that a digital currency will negatively affect banks' revenues?
So again, I don't cover monetary policy. I think the statement that a digital currency would negatively impact banks' revenues, I think that a significant one, we have not stated that a digital currency will exist. Importantly, and two, we have not stated that were it to exist, what design it would be. I think these are all really important questions that the board has raised in its discussion paper, and is why they wrote, is probably a reason why we think it's important to get this type of feedback. And so I think that's part of this long-term engagement with stakeholders, is to understand how could this impact all parties.
Puneet, did you have any thoughts on that, the negative impact on banks' revenues?
I think we are too early in the cycle to state that in terms of what services are offered, how they're offered, what it really means in terms of deployment. So I really think it's in the early stage. It is clear that there's a difference in what Bob also mentioned in the balance sheet nature of central bank digital currency versus regular commercial bank money. Commercial bank money is bank liability, it remains on the liability side. If it's a central bank digital currency, it's the liability of the central bank. So when we hold it, it is not on our balance sheet. Banks are like custodians, because ultimately that corresponds to the liability of central bank. So we're just holding, if you're holding in any account for a client, you're holding on their behalf, but it's not our liability to pay, it is the central bank's liability to pay. So it does changes to the extent that if it is very large and significant, it does changes the balance sheet composition possibly. But how does it impact revenue? What it really means, there's a lot of work which needs to happen. And that's exactly what policymakers around the world are doing at this point in time.
Thank you. Robert, back to you for this question from Andy. With payment platforms such as Venmo and PayPal widely available, why is CBDC needed?
I think that's a great question. And that's a major crux of the research from a technological standpoint is, do we need it? What benefits from a technology standpoint could we add? And what costs could we incur by trying to add it from a technological basis? I think that is a critical question. Certainly the private sector has done incredible innovation in the payment space. And certainly per this question and the prior question, our chair has been very clear that a key tenet of all of our work is to do no harm. And so what we focus on doing is understanding that cost benefit relationship from the technology standpoint, and understanding how we can do that without doing harm to the existing system.
Puneet, I'm going to direct John's question to you. As he points out, transactions have been moving digitally for as long as he can remember. You can do instant settlement from the consumer's point of view through Venmo and Zelle in dollars. Cryptocurrency is a separate issue that seems to get merged. I don't see why the Federal Reserve needs to be involved. Why not just let the private sector do its thing? As the guy from the private sector, do you agree with John?
I think there are different layers to this. So in some cases, some of the thinking is digital currency replacement for M0, where you have physical cash, and maybe some cases you want to have access to physical cash. So, and instead of physical cash, now time is the time to move to digital cash. And is this equal to digital cash? So there are different forms in which money could exist with different characteristics. Who has access? How that access get defined? So it is a complex subject, and this is exactly why the amount of work which the Federal Reserve is doing in terms of thinking through this, putting consultation out, requesting opinion. There'll be significant deliberation which is needed to ensure that the path we set out on is correct and thoughtful.
So Claire, let me add a comment to that. So I think the the volatility of crypto is really a concern certainly to regulators and to protect the public and protect the value that people are investing in. And there's a broader question, which is so interesting that I think that research is really they're investing in research to really figure out a lot of the answers to these questions. Because I mean, who would be the regulator? Is it the Fed? Is it the SEC? Is it the other agencies of the government? Currency trading. So what is this asset, and how would we regulate it? But I think that the Bitcoin to some degree had its founding in private undisclosed transactions that had somewhat of drug money, dirty money implications. So I think we've come a long way in terms of, I think, it being accepted as a valued and more current, more stable currency. But looking at the volatility just of the last week is just really concerning. So I think that's where the role of the Fed, I think, will ultimately come in my opinion. And I think there'll be regulators that really get involved, including, and obviously the commercial banks will be a core underpinning of that.
Next question comes from Kevin, and Robert, I'll direct this to you. Is it possible for a government to decide on one currency to be used internationally for taxation purposes?
It's a great question. The currency of the United States is the dollar. And so that's what and I'll leave that there. I can't speak for the IRS on their tax policy.
Puneet, Rob asks, and it's a two-part question. Should the US government be restricting or banning the use of Bitcoin by its citizens? For example, why has China banned Bitcoin in favor of its own currency? And two, is Bitcoin a threat to the dollar as a worldwide reserve currency?
I think these are great questions. And this is exactly the dialogue which is happening in Washington globally. This is exactly the kind of discussions, at the same time ensuring that innovations happen, at the same time ensuring the financial stability, consumer protection. So it's a plethora of those pieces which are out there, which are under debate and discussion.
So the next question comes from Ron, and Robert, will go to you with this. Isn't the current system akin to the balkanization of currency among the various states in the early years of the Republic? And doesn't it undermine a more universal currency?
I mean, so certainly we have multiple currencies. The US remains a reserve currency for a lot of reasons, and I'll defer to the economists at the Federal Reserve for that conversation. From a technological perspective, there have been discussions of, what would it take for, as a technologist, we ask the questions of what type of technology is necessary for a digital currency to exist throughout the United States? What type of throughput's required? What type of infrastructure is required? What type of transactions per second would be needed for every American to be using it where they want to use it, where we required to use it by Congress, say, for example. And then we ask questions of, from a technology standpoint, is if Congress or regulators wanted to make this available to all persons globally, what would the requirement be? Or alternatively, if Americans wanted to use a digital currency in another country, how could it work? What cloud network would it need to push through? And what type of infrastructure would be needed for that? That's how we look at this, is a question of what type of infrastructure could be needed where we asked to build it, and how can we give data points to policymakers to understand those costs and benefits. So for example, it'd be if American was trying to use this overseas, where this would be, are there security implications there? If they're running through towers that are owned by a different country's technology company, should we be worried about their data? Right? We want to understand all the technological implications so we can inform policymakers to make their larger decisions. And I think any country who's working on this type of technology is asking the same questions. Some countries may come to similar answers. Every country has their own use case. Certainly China has launched theirs. They're ready to go. I think everyone's going to learn a lot from that first mover action by China. But from our perspective, we have a lot of technology to learn, a lot of technology to build in a research standpoint, to understand how this can work even domestically, let alone globally.
Thank you. Puneet, the next question comes from Pete, and he asks, if one of the parties to a blockchain transaction believes
Lost Claire.
I'm sorry, it looks like I might have frozen there for a minute. So if I could just repeat for Puneet, this question comes from Pete. If one of the parties to a blockchain transaction believes they've been misled or defrauded, how can the matter be settled?
Given it is immutable, so once you put it on blockchain, it's immutable. Hopefully, before it is put on blockchain, there are criteria that is adhered to before it's put in there. If it's put in there, then you have to reverse it and rebook it. So it becomes the same situation. You paid out the money, and now you need to figure out how to do it. So in many of those scenarios, when folks are looking at this, they're ensuring that there are appropriate processes put in place, controls and checks prior to actually posting those transactions. If you post it, then it is a much more arduous process to reverse it, and you need to ensure that the counterparty is in agreement. And then you can, if your counterparty is in agreement, both of them agree, they can obviously reverse it and rebook it. So that's very much possible.
So if we could just stay on this for just a moment. If you remember the pipeline that was basically hacked and held for ransomware, Bitcoin was paid to the hackers to release the pipeline. But then some of that Bitcoin was clawed back. How is that possible? How were they able to do that?
Yeah, I do not know the full details of that in terms of how they are, but now there are tools available, and there are companies which actually are helping deeply see, because all these transactions are transparent. So when you go to the blockchain, you see every transaction. You just don't know who holds that wallet or that key, but you know it's holding there. And now through mechanisms where establishing connectivity between different wallets, establishing and understanding patterns which are there in the past. There are companies which are actively working in this space. We actually invested in a company about a month ago called TRM Labs, but there are others like that, which are effectively becoming the sleuths who are looking through this blockchain, trying to identify fraudulent activity, problematic activity, and many of those actually help through assess and claw back these funds. And then if you need to claw back, you need access to those private keys. So there are a lot of other pieces to it. But now we're definitely seeing a lot of innovation, which is driven towards understanding the transactions happening on the blockchain better.
Thank you. Next question comes from Ron, and I'll direct it to Robert. With Bitcoin and the like, how does a mathematical algorithm have inherent value?
Well, the value proposition for people who believe that Bitcoin has value is that there's 21 million Bitcoin. And it takes a certain amount of computational power to solve effectively puzzles that mine a certain amount of new Bitcoin. That amount of Bitcoin halves every 200, Puneet, you may need to correct me here, but I believe around every 210,000 transactions. A certain amount, and so the idea there is that at some point there's the people who believe that this has value believe that idea, that there's a finite number. It takes currently it takes a certain amount of energy to create new Bitcoin up to that number, and that will have value. That's the theory. And that's based on mathematics and computer systems that have yet to be hacked. I think that's one of the biggest claims to folks who believe in Bitcoin, is that it's been around now for 14 years almost, and it hasn't been hacked. It's the world's largest bug bounty, and it remains unhacked. And so that's what gives some people faith in it. But again, that's the theory. And other than that, we really don't think about it very much on our side.
Thank you. So I'd like to stay with you. This question comes from Tony, and he's talking about security from blockchain to blockchain. And he asks if you could speak a little bit more about wrapping tokens. And could you define what that means?
I mean, we're not working on that ourselves. The general idea there is that certain tokens get what's called wrapped in other protocols, most commonly ERC20 or Ethereum. And that is because of significant concentration in the crypto ecosystem of the ERC20 platform. So many wallets exist in ERC20 format, and many custodial systems exist for moving Ethereum or ERC20. And so when we wrap a crypto asset in most commonly Ethereum, what you're saying is you're just trying to fit in a certain bucket from a technological standpoint. That's the whole idea. But again, that's not part of my research.
So the next question, Puneet, is asking about blockchain security. You had mentioned earlier in the program about some of the fraud happening at the endpoints, and they're actually asking about enormous thefts recently. I just saw a report the other day about North Korean hackers being very involved, and I'm just wondering, how is that even possible?
I think what Bob said, the underlying Bitcoin blockchain where the transactions are stored, and that's the ledger. That ledger has not been hacked. It's not that somebody went to the ledger and changed what you own and moved it to somebody else. What has really happened is the way you access that ledger and your authority over the Bitcoin which you hold or cryptocurrency which you hold is through a cryptographical technique called public key, private key mechanism. So public key is your address where somebody could send. Private key is something which you own. And that private key gives you right to move those Bitcoin wherever you want to. So basically to be able to write transactions which will move the Bitcoin which you own. Again, I'm simplifying. It's a little bit more complex technologically speaking, but if somebody get access to the private key and they're not stored properly, then they can effectively get control over all the assets you hold on the blockchain. So control of the private key is essential in this whole paradigm. And there are a lot of security mechanisms which currently exist in order to secure it. Some people do it better than others, but the new cryptographical techniques which are available which say your private key will never be together in the same place because it's then easy to hack. It'll be sharded into small pieces. It'll reside in different places. So there are different ways in which you can manage it better. But one of the most common technique is to actually get access to the private key in order to get access to the transaction or the tokens which you hold.
Thank you. Robert, the next question comes from Tony. He points out that the attraction of Bitcoin and a major reason is that it's successful is because it's decentralized. So isn't centrally controlled banking and centralized government in opposition to this decentralization?
I think, as we've discussed earlier, the attraction of Bitcoin is speculative. Our focus as a central bank is to create stable money, full employment, and then when it comes to payment systems, safe, efficient, low-cost payment systems. And so that's our mission from Congress. And so that's what we're focusing on. If we can find new tools that forward that mission, that's what we'll do. If they happen to come from a place that may have originally been decentralized, so be it. But our job is to fulfill the mission given us by Congress to its fullest extent, wherever those tools come from.
Thank you. Puneet, I've got another fun question for you. This one comes from Boyer, who asks, how would you differentiate cryptocurrencies from the tulip bulb situation in the 1600s?
Yeah. This again is a big question out there. This is entirely based on demand and supply. So the price gets defined by the mechanics of the market and perceptions and so on and so forth. So again, I'm not a super like I haven't given deep thought in terms of the pricing mechanics and how that would kind of pan out. But really, it's demand and supply driven and confidence. And I think Bob had in a slide, trust being essential in terms of anything which has value, and having trust in the system, the trust in the code that says it could 21 million, trust that it will not be hacked and what you possess will be yours. So those are unique characteristics to give trust, but the price determination definitely is demand and supply driven.
Thank you. So this is an interesting question, Robert, and I'm going to start with you on this one. How do you justify the crazy amount of electricity being used to mine Bitcoin around the world, which equals some small countries' consumption when we still produce most electricity via coal and natural gas?
I never said I did justify it. I think that's a great question that I think Congress was asking this week. And I think it's something that's very ripe for discussion. I think the important thing for our research, in a serious note, is as we build this technology, how do we ensure that it does not have a significant burden on electricity, right? When we say efficient, we mean efficient in a lot of ways. And I think one thing that is clear that it is from our research, is a proof of work system, which Bitcoin is based upon, is unlikely to result in an efficient, low-cost payment system. And so I think that's when, from your earlier question, is Bitcoin money, right? Bitcoin, as Richard has noted, is a volatile store of value, but certainly has persisted for 14 years and generally increased value, or at least held its value, or at least held its network. But as Puneet noted, the definitions for money are store of value, medium of exchange, and unit of account. It's very few persons are using Bitcoin as a unit of account. And when you have such high energy expenses and such low transactions per second and such costly transactions, not only from an energy standpoint, but these things cost money in their own currency, right? So Ethereum costs gas to move. Bitcoin cost literally Bitcoin to move. And so we're not looking for that model as, in our research, because we think it's clear that if every American tried to use something with a proof of work model like Bitcoin as a form of American currency, it would likely fail the medium of exchange definition for money.
Thank you. Puneet, I've got a great question for you from Roseanne. You see crypto taking hold more quickly in developing countries where access to the US dollar or other Western currencies remains challenging and local currencies have limited value.
Yes, some of the early use cases have also driven by if a country is hyperinflation and the local currency is really cannot manage that inflation, and folks need something which is more stable, then this, because it's digital in nature, easy to access, and universally, or if you have access to internet, you have access to it. So hence, in many cases, that's exactly right where folks are saying this is a protection against the possible hyperinflation in the local currencies.
Thank you.
Particularly the case in Turkey right now.
So we're running short on time. This will be the last question. I'll direct it to Robert. It comes from Pete, and he asks, can you envision a scenario where CBDCs allow for unbridled control over the populace?
I don't know. I think that depends. Like I said, all these. I don't know what unbridled control of a populace means. But I think importantly, what maybe the root of his question is are researchers looking at CBDCs in ways to either better understand their populations or better ensure their privacies are protected? I think the answer there is yes. As we noted in our presentation, cash exists. Cash is useful to a lot of Americans. And one feature of cash is that it lets you conduct your small dollar business to yourself. And so how do you find that balance? Now, I think that's something that we try to understand from a technology basis is how can we ensure that persons' privacy rights are respected in their financial transactions while at the same time enabling our government to do its job when it comes to protecting against terrorism, money laundering, and financial crime. That's a critical balance that remains in need of a lot of research. And from our standpoint, that means technical research. New technologies are being built every day to help that happen, so that our police, our national security folks can do their job, and also that people's privacy can be protected. And that's going to be a major part of our leader research.
Thank you. I'm going to turn things back to Richard. I know you wanted some final words. We have about 3 minutes left in the program.
Hey, thank you, Claire. So thank you to both Puneet and Robert. This was fascinating. Still feels to me like it's the wild, wild west. And it's actually reassuring for sure to know that we have some really smart technicians and researchers and investment being made in researching this before we just jump in. Because I think the U.S. needs to be a leader in this world. Personally, this has been a learning experience for me, just researching for this discussion. I think the amount of non-fungible tokens that are out there. I mean, every McDonald's and every Walmart of the world and et cetera, are going to have their own little currency, and tokens. The whole regulatory side of this is going to be really interesting to watch. So we thank you so much for your contributions to the Vail Symposium, and we look forward to actually further discussion, perhaps later this summer or some other time, and invite you back. So thank you so much.
Richard, Robert, Puneet, thank you
you.
all very much this evening. It was a fascinating discussion. Everyone at home, thank you for joining us, and I hope you'll join us either this Thursday night. We have a webinar starting at 6 p.m. on with William Peters and Dr. Jeffrey O'Driscoll, and then next week we welcome Thomas Wright for a discussion on post-pandemic world order. Thank you all and good night.